and thank you for joining us today on our professional focus webinar with Flaxman Partners. I'm Catherine Kennett, Policy and Public Affairs Manager at the Chartered Insurance Institute, and I would like to welcome you all to our final session of 3 on claims-made policies. The third webinar will take a look at policy definitions of circumstances, including could, might, likely, etc., and whether there is much difference in these. We will include examples to illustrate how differences of opinion occur. Finally, we'll explain what is meant by run-off liability and retroactive cover and how to apply these in practice. So many questions and issues have arisen since we started this series that our duo have planned an extended Q&A session during this concluding webinar. We have with us online again today Roger Flaxman, Chairman and Principal Consultant, and Michael Wilson, Director at Flaxman Partners. As mentioned, there will be time for questions at the end, so please feel free to use the question box you can see on your screen. Without further ado, I'm going to hand over to Flaxman's.
Good morning, everyone, and welcome once again. I am still Roger Flaxman, and with me, as ever, is our Senior Consultant, still Michael Wilson. Now, today, sadly, is the last in our series for the CII, but we'd just like to say how much we appreciate the feedback you've been giving after each webinar. It's been really fantastic. So we know from your very kind and helpful comments that you value the webinars, and so do let the CII know if you would like us to produce some more, perhaps in the autumn. Now, I should also like to thank my MD, Anthony Dannison, and our production manager, Ellen Appleton, who between them provide the rather entertaining presentation slides and the fact sheets. Now, don't forget the fact sheet because it sums up everything that we're talking about in each of the webinars. Thank you for all of that. Now, I'd also like to thank Eleanor in particular for putting our messages into YouTube. Now, I don't know if you've seen this before, but if you wait for our final slide, you'll find the YouTube Flaxman URL. And we've done this particularly so that you can give your staff or your clients, if you like, some guidance on some of the things we're talking about. They're worth a look. They're really very good. Eleanor, in fact, is a professional actor, and when she's resting, she's working with us. It's very useful. We are well aware, by the way, from your feedback and from the mountain of questions that we get after every webinar, that you really value the opportunity to talk about things. So today we're going to make at least half an hour available to answering your questions on anything you like from the recent webinars or anything else you like. If you like, we really don't mind. You know, that's what we do. So obviously we won't be able to take everyone's questions, but as we've said before, if you've got a burning question and you would like a view from one of us, then you're more than welcome just to contact us, and we're very happy to speak to people about these things. We are genuinely keen to help our industry to help itself. So now today's webinar, and it is going to be shorter by design, is concerning the vexing question of circumstances. Now, when I was a bit younger than I am now, back in 1975, there was a meeting of leading PI underwriters in the London market to discuss the question of what constituted and how you would define the word circumstance. Now, bearing in mind, in 1975, PI was only about more or less than 10 years old as a concept. And the objective at that time was to find a definition that the Law Society of England and Wales could agree to. It never happened. And today, nearly 50 years later, there is still no universally accepted definition of a circumstance. And more importantly, there's no market agreement as to how to treat notifications in practice. So today we're going to look at how we as practitioners can manage an imperfect situation with, as always, a focus on fairness to the insured. So let's make a start with today's introduction to the circumstances and how to deal with them. Mike, over to you.
Well, thank you. First of all, I just need to revise the learning objectives for today. So it's to revise and understand issues connected with circumstances, as you've just been saying, Roger, to appreciate why an underwriter requires prompt notification, to be aware that not all notifications are accepted by the underwriter, an introduction to retroactive cover, and to understand the need for runoff cover at the cessation of business. Now, just to make a start on this definition of circumstances, as Roger has already mentioned, there is no universal definition. But we've sort of come up with our own pointer on this, and we've put it on the slide here. And we're describing circumstances as, or a circumstance, as something that happens or does not happen in the course of the insured's ordinary business that is out of the ordinary and not intended to happen. So this is not a definition that you will see in any textbook. It's not a legal definition, but we thought this was actually quite a helpful description if you find yourself having to explain this to one of your customers. Just going on to the next slide. So what might a circumstance actually look like? So we put some examples here. It could be some disappointment expressed by a customer. It could be increased cost in money or time to the customer, something which could cause harm to the customer or to a third party, or an unintended consequence that may lead to damage or of the customer relationship, or indeed the reputation of the insured. So those are some of the appearances of a circumstance. I suppose if you've been in insurance for any length of time, some of these things you will know by instinct, but sometimes the difficulty is getting this over to the policyholder as to exactly what it is that should be notified. Now, this then brings us on to a very interesting aspect, because not all policy wordings are the same. Many policies don't even include a definition of what a circumstance is. But normally there will be a requirement to declare circumstances that may lead to a claim, might lead to a claim, likely to lead to a claim, could lead to a claim. And we put there, and does it make any practical difference? Because I've seen well-intended guidance notes written either by people in the insurance business or maybe lawyers who've tried to put percentages on these words. So I saw one that said, well, if it's may, then if you think there's a 20% likelihood of it becoming a claim, then you should declare. Whereas if the policy requirement is anything that's likely to give rise to a claim, then you make an assessment as to whether it's at least 50% going to produce a claim. And I would like to ask you, Roger, whether you feel that this sort of guideline is helpful.
Fundamentally, I don't. And just because there might be some people out there today who don't know some of our background, I've had to spend a lot of the last 20 years giving expert evidence in courts of law. So I've had these discussions with lots of solicitors and barristers. And I can tell you there is not a universal opinion about this question, even amongst the legal profession. But looking at it like this, there is case law that has cited these definitions, and particularly that's where the percentage comes from under the term likely, and I think it has to be more than 50%. But I'm not persuaded by case law on a lot of things, because one of the arts of the law generally is to distinguish every new case on the facts, distinguish it from the previous one. So I would say, as far as practitioners concerned, just treat every one of those as the lowest possible denominator, which is the word could. If something could give rise to a claim, then notify it. Don't try and make a judgment as whether it may, or whether it might, or whether it is likely, because actually the only people that can make that judgment is the court. And that is in the light of all of the facts. And the problem with a circumstance is that it's the beginning of a journey when nobody knows the facts. All they know is the emotional consequences of where they are at the time. And that doesn't really carry any weight at all. So my advice is always regard a circumstance is, could it give rise to a claim? Now, there's an acid test for that, which is, could you say that it could not give rise to a claim? And I've never come across a situation where I could say that. I've come across situations where I said, I think it's pretty unlikely, but we, in insurance practice, are not in the shoes of a trained lawyer who can actually turn dust into gold when it comes to legal principles, because they can say, well, here is a reason that it could. So it doesn't really matter what we think. And from the point of view of the customer, or the insured, the most sensible thing to do is to say, look, in our opinion, we can't say this couldn't give rise to a claim. We're not interested in the likelihood. We just want you to notify it. And we'll talk about the notification process later, but I would wipe away, frankly, from our general practice, trying to make any kind of judgments on likelihood. Just leave it alone.
Well, that's very helpful, Roger. Thank you for that. And of course, it leads on to the question as to why exactly does the PI insurer need to know about these circumstances? It's quite a heavy burden on the policyholder to keep thinking of circumstances that might lead to a claim and having to put in a notification. And of course, it's something that no policyholder really wants to do.
No, well, certainly not.
Because if we're talking of PI policies, generally speaking, they're not the cheapest policies available. The policyholder is always very conscious of the cost. And so therefore there is a reluctance, a natural reluctance to put in notifications unless they're really convinced it's going to be necessary. So
yes. Well,
it's useful just to remind ourselves, why is it that the underwriter needs to know? And of course,
fundamentally, the underwriter is in a position where he's entered into a contract that says, I will indemnify you against the perils of having a claim made against you. But when something happens that is likely to be a claim, I want to know. Now, he wants to know because he wants to do or not do those things that will protect the insured's position, and indeed his position, as soon as possible. And the problem that is extant, and it has been, all the time that I've been doing this since the 1970s, the problem is that people try and sort out their problem for themselves. Oh, you hear the expression, oh, no one could sue me for that. I couldn't be liable for that. That wasn't my fault. That wasn't my job. There are millions of excuses. And people are fundamentally in denial when they're criticised. Nobody likes being criticised, as far as I know. And I think you've got to put it in that context, that you're never the best judge of something when you're the victim, the target. So why does an underwriter want to know? Because he has entered into a contract with the insured to give him that protection. And to give him that protection, he needs all the ammunition he can get, and he wants to stop any chance of the insured prejudicing his own position, and therefore the insurers, by having discussions or entering into agreements or whatever that might cause the thing to go off the rails. And it's very simple.
Okay, well, thank you for that. Before we move away from this slide, I'm particularly grateful to our production team for the graphic. So if you find yourselves, for instance, having to explain to a policyholder the principles of subrogation, and you'd like to have license to use that graphic, feel free, because that's a very good example for the explanation of subrogation, as well as why underwriters need to know.
It rather suggests, Mike, that insurers have big feet.
Well, we'll better not comment on that. So I've come across cases where a policyholder, perhaps with the abundance of caution, has put in a notification because they've been convinced that that's what they ought to do, and they expect the insurer to sit on that notification until anything else happens. But then they find that the insurer responds by saying, well, we're not accepting this notification. So what does an insured do if the notification is rejected? Because on the face of it, it seems quite unreasonable.
Yes, this does happen. Now, this is a real problem. Occasionally, I don't think it happens very often, but it does come up. I'll give you an example of the first time that I came across this. And it was a really big incident. Again, I'm afraid it goes back to my early history. Back in, I think it was the 80s, there was a new product that was invented called high alumina cement. And this high alumina cement, the high alumina bit, was concerned with the process of quick drying. So it could cure much more quickly than conventional cement. But one of the properties of it, it turned out that they found out later, was that if it was raining when they used this cement, then the additional water content of the rain weakened the concrete. That was a scientific finding several years later. But in the meantime, high alumina cement had been used particularly in motorway bridges, the building of the motorways in the 80s, and some of these collapsed. And also there were collapses in municipal swimming pools and schools where similar use of high alumina cement had been made. Now, once these claims became known, there was an absolute deluge of claim circumstances notified by architects, consulting engineers, contractors, and almost anybody who'd been involved with a contract where high alumina cement had been used. They may not have used it themselves, they might not even have specified it, but it had been used. And such is the uncertainty of the question of notification of circumstances, even now, such is the uncertainty that people said, well, you can't afford not to notify. So they did. And the insurer said, no, we're not accepting it. And that was the first time we had to really think very, very hard on what we're going to do. Now, I was working for a large broking firm at the time, and the broking firm decided to take legal advice on this with some pretty heavy-hitting lawyers. And the insurers quietly backed down, and said, well, we won't exactly reject it, but we'll take a view. And actually, they didn't do very much at all, to be honest. There was no definitive outcome from it. But to the best of my knowledge, people that had a genuine claim didn't suffer. Now, another incident, which is much more recent, and I was involved with a couple of other people in the PI market that you'd probably know, concerned the pension mis-selling and mortgage mis-selling. And the question there was if an organization knew, for example, that the FCA was intending to have a close look at a particular kind of product that had been on the market, does the fact that the FCA have announced a consultation on it, does that amount to a notifiable circumstance? And the answer is yes, it does. Because you couldn't say it doesn't. That was the test. You couldn't say it couldn't. In other words, depending on the outcome of the FCA, they may actually have said when everybody's now got to do, and then given them instructions what they have to do, from which a loss could very well flow. Now, the reason we were involved in this is because the insurers said, no, this is not a circumstance. And there was one particular case, I can tell you, there's 28,000 policies issued, mortgages issued by one company. 11 of them had proved to be at fault, and therefore there were extant claims going through the process. But all the rest were silent. And the question was, well, are there in fact 28,000 more claims out there just waiting to hit? And you couldn't say there wasn't. So it's a real problem. And all I can say on the subject of rejected notifications is this: there is case law concerning what constitutes a notification. And because we're not lawyers, we don't go into talking about case law in this kind of forum, but it's quite easy to look it up. Fundamentally, the issue is the matter specific enough? And going back to the 28,000 mortgages, you could argue that that is specific enough, and you could argue that it's not specific enough. And it depends which side of the argument you want to be on and how strong your legal team is to how you will succeed. It is not it's not binary, as they say. So if you get into a situation of rejection, then is actually take advice. Don't try and guess it, because you won't get it right. It's just one of those things we have to take on in the facts at the time.
Just what I was going to say, Roger. So thanks very much. We've got a couple more slides, which I'm just going to zip through, and then we're going to go straight on to some questions and answers. Just to touch on the issue of retroactive cover. Most policies, most PI policies, for instance, do not have a retroactive date on it, which means that the policy will pick up any claims that relate to past work. But where you've got a policyholder who hasn't had insurance before, it might be an IT consultant who's been working for a year or two before he realizes that he really ought to have PI cover. In a situation like that, the underwriter doesn't really want to pick up the liability for past work when there was no insurance in place. And so the retroactive date will probably be the date that the policy was incepted. And then it would only take care of claims that arose from work done from that date onwards. It's fairly uncontroversial, so I don't think we need to discuss that. The other issue, which is a little bit more irksome for the policyholder, is the need for runoff cover. And it's normal for a professional to need to cover their liabilities for another 6 years once they've ceased to practice. And this can come as an unpleasant surprise. So if you have an architect who decides he's going to retire, and he says, well, thank you, I don't need my PI policy anymore. It can be a bit of a shock to realize that they really do need to take out runoff cover to cover claims that come in over the next 6 years. So it's just a standard piece of advice that needs to be given to a retiring professional. The best way of dealing with it, if you are advising a professional who's thinking of retiring, is to find somebody who can either buy his business, or perhaps he can go into a merger, because then whoever acquires the business, it would probably have been agreed that they would also acquire any liabilities, in which case the new practices PI cover will pick up any claims. It's very similar to the principle that applies in the legal profession. So if a solicitor's firm merges with another, then there are automatic rules that dictate which firm will actually be deemed to be the successor practice, and then that firm picks up the liabilities and also the need to insure. But it can get a bit complicated, and again, it's another issue where, if in doubt, it's best to take some specific advice. But unless you've got anything to say on that, Roger, I think we'll move on to the questions and answers, because we we have quite
Yes.
a lot from previous webinars that we haven't dealt with. So I'm going to kick off with one, and then Catherine, who's our host, will then feed in other questions, and we'll alternate them, I think. So the first question I've got here is, so how does one get the policyholder to understand that they need to notify anything that may give rise to a loss? The problem being that in their own mind, they are, as you say, in denial and believe that they can fix the situation and it will not become a claim. So how do we get that message across to the policyholder?
It's pretty difficult. Some policyholders don't want to listen. Others are very anxious to listen. But I think that the overarching advice that you need to give to a client is, look, if you don't notify it, and this becomes a serious problem, you could be uninsured. And being uninsured in a situation like that could terminate your business and your reputation. You know, the insurers will give you no truck, and the claim won't stop just because you're not insured. That's the stick bit. Now the carrot is this: if you handle a notification well, you can say to your insured, look, I know you don't want to admit that this might be a problem, but you've got an insurer out there who has agreed to defend you if you get a problem like this. Now, I'm sure you're probably worried about if you tell him, he's going to think the worst of you and he's going to put your premium up or may not offer you insurance. I can say as a practitioner, that's you, that very rarely happens, because most insurers are quite straightforward and honourable about this. And if you tell them the truth, you tell them the facts, then they will normally say, okay, this is what we do. Now, one of the tips that I would give you is this, that if your client is the kind of organisation that says, look, I think this is a misunderstanding. I've been doing this kind of work for 30, 40 years, and I know how to handle these situations, then actually, if you go to the insurer with the notification and say, the insured wants to do this because he thinks he can get rid of the claim, quite often the insurer will say, okay, keep me advised. And then as a broker, you can either take advice from, dare I say, somebody like us, or a lawyer or whatever, but just to keep the insured away from problems of saying things that he shouldn't. It can be a very effective way of persuading a client that actually notification is the safest thing. And then if they fail to get the solution, then at least they haven't lost their protection from the insurer. And let me just add this. In the work that we do, we get dozens of situations which are precarious and you really don't want to go to litigation. And once the insured feels comfortable with talking about it with somebody else, very often a solution pokes its head up because the other side doesn't want to go to law either. And then suddenly you're in a position where you can have a mediation. And mediation, 75% of them are successful on the day.
Okay, Roger, I think we need to go on and pick up another question, if you don't mind.
Yeah.
Catherine, could you pick up one of the questions from today, please?
Sure. Our first question is, could you use if, i.e. if it could lead to a claim, what are the implications? So
I'm not too sure if I quite understand.
I think he's trying to put the word if in front of could.
Yeah.
Ah, yes.
I don't think it makes any difference, to be honest. I mean, the active word is could. I mean, I think the answer is yes, you can use if, because it won't make any difference if could's in the same sentence. So right. I can see what you're saying, but that's, I think, the answer.
Okay, that was a fairly short one. Can you pick up another one, Catherine, then I'll go back onto my list?
So another question we have is, if a notification is rejected, does it really matter? If the obligation on the insured is to notify of events that could rise to a claim and the insured does so notify, then surely the insured has satisfied its obligations under the policy.
Could I come on that one first, Roger?
Yes, please do, because I've never discussed that. Yeah.
Because I've got some sympathy with the sentiments behind that question, because after all, the policyholder can only do what the policy asks it to do, and it's put in the notification. What else can the policyholder do? So the question is, well, does it make any difference? Well, actually, yes, I think it does, and I don't think it should go unchallenged, because if a claim comes in, shall we say, during the next policy year, it would be a reasonably straightforward matter for the policyholder or the broker to refer back to the attempted notification, which would help to defeat any suggestion that it's now being notified too late. However, it's a completely different set of circumstances if you've switched insurers. So the original notification went in to insurer A. The claim comes in while the insurance is with insurer B. And the policyholder says, well, I attempted to notify this last year. And the current insurer, insurer B, says, well, that's not my problem. And then you get a very interesting discussion as to how and whether the
You also get the problem that the second insurer will say, and I'm going to void your policy for failure to tell me about the notification, because it's a breach of material fact.
Well, Roger, this brings us up to a crucial issue about PI insurance in particular, about the dangers of switching insurers at all. Would you suggest that, all things being equal, that continuity with one insurer is something to aim for?
Well, I would, but I know that also it's kind of impractical in some ways. I'm very aware of it. I'm dealing with a very interesting situation for the RIBA at the moment, architects, and talking about the problem that they're having with lots of competitors offering half-price cover. And the temptation, particularly for young firms, smaller firms, is massive. They're going to half the premium, but it comes with a very, very significant risk. The point is that PI insurance, because it's on a claims-made basis, is actually beyond the understanding of most policyholders, and they don't recognise what these pitfalls are. So it's up to us in the industry to point them out. And I think the answer is this, to your question, which was, do you think it should suggest that you shouldn't change insurers? I think you've got to be aware that if you do change insurers, you've got to have a very, very careful look at what circumstances might exist in the background that need to be notified before you change. And at one time, one of my jobs actually when I was broking was with some fairly big clients, is to go to them and say, if you're going to change insurers, you've got to ask every partner and director in your firm or company if they are aware of any circumstance, because we're going to notify it before we move at the end of the year. And that used to happen quite a lot. And that's the only defence that you can make to it, really.
I would say morally, coming back to that question, that under those circumstances, insurer A should still deal with it.
Well, they should, but then it comes down to... I mean, yeah, I don't disagree.
There's likely to be a massive legal dispute about that. But I mean,
which is why
that would be my approach.
Which is why, really, it's not that bright to try to reject it, is it? I mean, I think the point is, if you come back to the could point, could it give rise to a claim? Yes, it could. I mean, the reason the rejection of these big multiple type claims is because the reinsurance costs. There are lots of implications for that. If it's just one event, normally insurers are a bit more sanguine about it. But there may be an insurer out here listening who'd like to make a comment on that. I don't know. But I can see both sides of the story. And I think continuity is wonderful. But the other side of the story is this. I think insurers have got to invite and incentivize continuity. And some do and some don't. There's far less loyalty now than there used to be. 20, 30 years ago. So that's a
One,
market.
one question that came up, I think it was last time, was what happens if a client tells a broker not to notify the insurer? But
What happens to whom?
Well, sorry. So the client tells the broker not to notify the insurer, but later on, when it all goes pear-shaped, the client claims that the broker has been negligent. Have you come across that?
Well, I think yeah, I've seen that. Yeah, I've seen that several times. The answer: this is why brokers must keep notes. I've just come out of a trial 2 weeks ago, where I was in fact on for the broker side, but found it very difficult to defend them because they made no notes at all for 13 years of their client. They had a very cosy relationship with the client. Something went very, very badly wrong on a business interruption claim, and there was virtually nothing written down on paper over 13 years. And all I can say is, in the age of electronics, etc., the idea of using a pen and paper has gone out of fashion with an awful lot of people. People don't make copious notes, but clients are more likely to, because they'll say, oh, I told my broker that, probably put it in writing. All I can say really is just make a record of, if you're instructed not to do something, that's one of the most serious things that you can be told. I don't want you to do this. I've even said to people in the past, if your client's treating you like that, do you want them as a client? You know, this is really serious stuff, Mike. So just write it down, and then if you say, well, I was told not to do it, then the question will be, well, did you have an obligation to tell your client not to be so silly? And I've heard that.
Well, of course, these days, many brokers have software that help them with keeping the record up to date and making file notes. But another practical suggestion is, if you've had that sort of conversation with your client, is just send them an email confirming the conversation. And then everybody's got the same
put it in writing. Absolutely. Absolutely.
Catherine, have you got another question there for us?
Yeah, I just would like to make some comments that Tom McGrath has given regarding the session earlier, and he's just saying, Roger, blanket notifications. You and I have had experience of these, and he also Michael disagrees with regarding retroactive date, saying it's more common. So just those comments there, but. Getting on to the next question. Getting on to the next question, it's IFAs have no sunset clause on liability, so 6-year runoff cover may not be much use. What do you see as the possibility of moving to a claims occurring basis?
Zero.
IFAs are in a particularly difficult position. Because the FCA will not effectively give them a long stop in their liabilities. So I think for IFAs, who seem to be in a worse position than most professions, really ought to do their best to merge with somebody else before retirement, or sell the practice, because even a 6-year runoff cover may well not be enough. It's a very difficult situation.
It is, yes. This has been a recurring problem again, for nearly 50 years, and the market hasn't found a way of dealing with it. It's important for everybody that is discussing this subject with a client to know the principles of the Limitation Act and why 6 years is the period of runoff usually sold. The fact is that often with financial products, the loss doesn't come to light until well after 6 years has expired from the time when the product was sold. And therefore, it is a real problem, because once the 6 years is up and the policy is expired, there is no protection. Now, it's much too big a subject to go into today, but the question is a very good one, because it is pointing to something where I think there is a need for a long stop solution, and it's not beyond the wit of man to do it. But and the Law Society, funnily enough, they've got that problem as well. I was talking to somebody very senior at the Law Society only 2 or 3 weeks ago on this very subject. How do we deal with it? And the answer is it costs money, and that's the problem. Nobody wants to pay for it.
Another question that's on my list is, if many claims come from prior years on a claims made policy, the limit may be exhausted? Question mark. Well, yes, of course, that is a possibility. But to try and put this question in the right context, how do you actually fix on your limit of indemnity? Because we haven't discussed that, have we? Because it's all too easy to buy a sort of standard £2 million or £5 million limit of indemnity. But how is a broker to guide a client if they
funnily enough, I've written the answer to that question in an expert report yesterday afternoon. Exactly.
I rather set myself up for that one, didn't I?
Well, you didn't know that, but it's exactly that question. What should the broker, how should the broker, or what should the broker have done? First of all, a broker doesn't have an obligation to identify or set a sum insured or limit of indemnity for anyone. What they do have an obligation to do is to explain to them how to go about setting their own. Now, in property insurance, basically the answer is go and get a valuation for reinstatement. Usually, that's what it's all about. In liability insurance, it's much, much more difficult. But the real issue is this: the business, the size and nature of the business will often tell you something about the prospects of the kind of claims that could be made. Now, most people are aware at the moment of the cladding issue that's circulating around the universe, and the size of the claims that can come out of a cladding type claim, consequential issues arising out of that, they run into the millions. So, for example, I've had architects say to me, well, look, we never buy more than 5 million, but we now think we might be at risk for up to 25 million. What should we do? And the answer is, well, you could actually stick at 5 million. And are they going to sue you for more than the amount of the insurance policy? That's a perfectly reasonable risk to take. The alternative is, well, do you want to buy 10? But if you've got 10, the claim's 25 million, you're still going to be short. Do you want to buy 25? The problem is, once you've bought a very, very large limit of indemnity, it's very difficult to go back from it. And then you've got to think about the runoff. So how do you pick a limit of indemnity? We could probably actually do a webinar on that, because it would take an hour to go through the examples. But fundamentally, there's two ways of looking at it. What is the likelihood? What is the potential cost arising from the kind of work the firm does? Is it thousands, tens of thousands, hundreds of thousands, or millions? But the other aspect, which is actually a very good countermeasure, is to consider the cost of litigation. Now, I would say that the minimum limit of indemnity for anybody in business anywhere that buys a PI policy should be £500,000, absolute minimum. Preferably each and every claim, but £500,000, even if it's in the aggregate. Why? Because that is the kind of money that very, very quickly goes in a litigation process where the claim won't go away. £1 million is less common, but becoming increasingly common. And I'll tell you why that is. Because technology is creating a problem in the legal profession with voluminous documentation, all of which has to be gathered, examined, and disposed of. In other words, read. And it takes hours and hours and hours, and it's adding huge amounts of cost. A lot of it is irrelevant, but they've got to see it. And again, going back to my little courtroom tales, I recently had to go on a matter where there were over 2,500 documents in this trial. and I was given about 700 or 800 of them. I couldn't remember all of that. You have to read it over a period of 2 years. You can't keep all that in your head. And the point is that the profusion of documents is actually adding to the cost of litigation. So when you're looking at it from the point of view of never mind how big the claim is, what is my risk? If you weren't insured, you could very easily find yourself stomping up $250,000, $500,000, $750,000 in just pre-trial litigation costs, even if you're a small firm. So my view is, how do you pick it? You've got to have this kind of conversation, and also get a view from your clients' peers. What do they do and why? Look at what the professional bodies say on their websites. That's always useful stuff. There's no answer to it, but that's the way you go about looking at it.
Thank you, Roger. Back to you, Catherine.
And we've got some questions about runoff. Somebody has said that they're always being asked by clients, what is the position when the practice they've been running and insuring has now been closed and dissolved? How can a claim occur against a company that no longer exists?
Oh, yeah, okay. Well, the answer is it's all about third-party rights. And that's a big subject, and it's a legal subject. But fundamentally, the Third-Party Rights Against Insurers Act, and I've forgotten what the year it is, it's 2010 or 11, I think. But it's a revision of an old act. And what it means is that you can go against the insurer of a company that's been put into administration or liquidation. And it's a very complex process. We happen to be doing one at the moment, and it is indeed complex. But there is a route there to be explored. And my advice on it, rather than take up a lot of time now, is to just accept that the third-party rights against insurers is a provision for just that kind of situation. You won't come across it very often, but if you do, go straight to a lawyer who is an insurance specialist, because you need to really know what you're doing
Just
to how to handle that.
Just to add to that, Roger, if you have a firm that has actually gone into liquidation, but there is still a policy in force, then what you've just said is absolutely right. Under the Third-Party Rights Against Insurers Act, the claim could be submitted direct to the insurer.
Yeah.
But in a situation where there has been no runoff cover,
yeah, well, there's no runoff cover,
and that insurance has expired,
yeah,
then there is no policy for the third party
if there's no policy, no.
To pursue.
No, the only thing you can sometimes do is to, I mean, we've got a case at the moment where the administrator was a bit previous in cancelling the policy. There's a dispute as to whether they had the right or the obligation to do so. And all these matters are very sensitive matters of law. But my message is, when that kind of thing happens, take advice. Don't just give up, and don't give advice as a broker as to what the situation is, because you'll probably be wrong. Not that you don't know what you're talking about, but the law will come up with something that you haven't thought about.
Catherine, do you have others on the same subject?
Yep. On retirement, this chap says he's come across situations where runoff cover was not available for non-engineering business in the absence of runoff cover. What does the professional do to protect itself? Does it just notify the PI insurer of every bit of work carried out in the final year?
Yeah, good question.
That's a nice idea. Well, if there's no runoff cover, I don't think there's an answer. You can't notify everything you've done because it wouldn't be specific enough, and that would be, even in my, if you like, client-centric view, I think that would be a step too far for acceptance of a notification. I think the answer is, if you don't buy runoff cover, you don't buy runoff cover, and you're exposed. I can't really see there's anything else to say. If you can't get runoff cover, that's very sad. And in fact, Mike and I were talking about this the other day and saying, one of the things that a really good, competent broker might say to a client that recognises that there's going to be a succession looming, is to say, look, you want to start thinking about succession and or runoff at least 2 or 3 years before you need it, because it might be difficult to get when you need it. And you might find that there's somebody willing to take over your business, which will also take over your runoff. And actually, quite a lot of people do that. So that's the way to think about it.
Catherine, have you got more on that subject?
I do. In the world of PI, who would really need a runoff cover? Does it apply to all professions, or just a perception from a company perspective that we would need it, just in case?
No, everybody. Well, let's look at the word need. The answer is, if you finish your practice, whatever it is, doesn't, you could be a podiatrist, or no matter what it is, doesn't matter what it is. If you're giving advice and services where you need PI cover, then theoretically you do need PI cover when you've retired, when you've stopped practicing, because the claims can still be made against you. Now, there's 2 things you can do. One is to protect yourself by winding up your company and making sure that you've got no personal liability trailing behind it. The other one is, if you're not in a company but an LLP or a practice or just a sole practitioner without any protection, then actually it's very difficult to remove yourself from professional personal liability. So they're the 2 things you can start with. Do you need PI cover? If you're very wealthy and you've got plenty of assets, and if somebody has a go at you, you don't need anybody to do it for you, then you don't need PI cover. But I've never met anybody like that. So, yeah. And even some very wealthy, partners of some very big firms, they've all said, well, the first thing we want to do is to buy protection in retirement. So I think, realistically, everybody needs runoff cover when they've been in practice. You couldn't give good advice to say that it's not needed.
There was one question that arose during one of our previous webinars, and we did touch on it once before. This is going away from the runoff issue, but is more to do with notification of circumstances. And that is that most policyholders will not engage with the whole idea of notifying circumstances unless they're in receipt of a claim, which quite often is too late, as we've already identified. So if you're advising the policyholder, whether as a broker or as an insurer, what is the best way to engage with the policyholder to make sure that there's a better level of understanding? And I think the suggestion that we made on a previous occasion, Roger, was that some sort of mid-term review would be of enormous benefit, because at renewal,
yes,
all the focus is on getting the cover, agreeing the terms, trying to minimize the premium. And yes, at renewal, there is that general duty of disclosure.
Yeah.
That's all part of the package. But a review at the 6-month point would give the advisor the opportunity just to remind the policyholder how the policy operates, about the need to notify circumstances. And that would be a more relaxed conversation, even if it's just a chat over the phone. It would be a good opportunity to
agree, I think engaging people on this subject, the only thing I can say, and having done it, is you've got to be always there. You've got to find a way of engaging your client in actually anecdotal stories. It's not a question of, if you sit down and say to somebody, look, I think you might have a problem because you haven't notified something, and I think there must be something in your closet that you haven't notified, you're going to get their back up straight away. I think that the best way of engaging people is to regularly talk about other people's problems and let the client work out for themselves, there but for the grace of God go I. That's the best way of doing it. And you can either do that by webinar, or you can do it with written anecdote, what do you call it, case studies, newsletters, however you do it. The problem, Mike, that I'm very conscious of nowadays is that far fewer brokers or insurers see their client, and the opportunity for a conversation is pretty much gone. And it's not the kind of thing you're going to do on a Zoom. So I think the answer is that it would be sensible to say, well, is there a way of better engaging? And I tell you this, without any fear of contradiction, putting more things and warnings in letters, in brokers' letters, we're warning you, it just doesn't work. It just doesn't get read. And even the courts are beginning to say, now, look, this is nonsense. All this, you get a policy of 30 pages and warning letters of 52, and it's happened. No one reads it. It's all very well saying, oh, I put it in writing to warn you. But everybody's getting tired of it, including the FCA. We're talking about them about that next week. And I think the point is that we are in a crisis, in a way, in a world where actually we're interfacing with customers less and less and less. And so these questions are very good ones, and maybe they're coming up because people are actually screaming for a solution.
Yeah. Catherine, have you got time for one more?
Yeah.
We have got a question. I'm not sure if we can cover it, but let me ask you anyway. Can a broker give advice on how long retroactive cover should be bought for, or must the insured seek independent legal advice due to variations of duration required depending on the profession? If you could summarise perhaps in a minute or so.
Well, I think the answer is you can't give advice on how long because you don't know. So don't try. And I'll tell you what, if you take legal advice on it, they won't know either. And the bottom line is you've got to buy it for as long as you reasonably can. And what I would say is this: if you buy it for 6 years, which is the recognised period, you're not going to be criticised very much if it happens in year 7. I mean, the bottom line is, I'll just say this, that most lawyers, the first thing they look at nowadays is there any insurance? Because if there isn't, it's probably not worth suing the other party. And they know that if the party hasn't got any money to pay a claim, they probably haven't got any money to pay legal fees either. So it's pragmatism. And the answer is, broker, don't give advice how long. Your advice should be the norm. The norm is 6 years. There are occasions when you can buy more, but you'd have to take, we'd have to take special circumstances, and that requires a conversation, on the facts. And then you might want to get a lawyer or somebody to assist. But don't try and give legal advice.
Thank you.
All right.
I think we need to wrap up there now, but I think thank you very much, both of you, for delivering this webcast series. We've definitely touched a nerve, which is great because it gives us all the opportunity to make sure that we fully understand this slightly unusual and sometimes hidden corner of the insurance market. Just to let everybody know that all 3 sessions are now available on demand, and please feel free to share the links with anyone you feel would benefit. We've also got up ways to contact you both, Roger and Michael, and there is the series on YouTube with any further questions and answers, I do believe. So thank you to all the delegates for joining us today and throughout the series. And once again, a huge thank you to Roger and Michael. Hope you enjoy your day.
My pleasure. Thank you.
Okay.
Bye-bye.